I mean, on a technical basis, on a nominal number, gold's overbought and probably correct somewhat. Silver probably sympathize with it, but on a amount of currency printed basis, I mean, gold's about as cheap as it's ever been. So we really have a long ways to go. I mean, if you want to go back on a sound money standard, you'd have to push gold up to about 20,000 the ounce, which is eightfold what it is from now. And we had a pretty good run from 2000 to 2011. Gold went from like 252 to about 2000. We had about an eightfold increase, sevenfold, something like that. So could it do it again? I'd say absolutely. So you could go, from 2,500 to, into the 1,000, 10,000, 20,000.
While gold appears overbought, it's still relatively cheap when adjusted for the amount of currency printed. They argue that if we were to return to a sound money standard, gold would need to reach about $20,000 per ounce, which is roughly 8 times its current price. Reflecting on past performance, they note that from 2000 to 2011, gold experienced a 7 to 8-fold increase, rising from about $252 to $2,000. They believe a similar price surge could happen again, suggesting that gold could potentially rise to $10,000 or even $20,000 per ounce. David Morgan is a well-known figure in the financial world, especially recognized for his expertise in precious metals. He highlights a financial adage in a fiat system: true deflation or debt liquidation never occurs. During the 1930s, under a gold standard, currencies became more valuable, and prices fell because gold was confiscated and repriced, stabilizing the currency. In contrast, fiat regimes historically lead to hyperinflationary depressions, characterized by high unemployment, uncertainty, lower living standards, and a failing currency. The only currencies that remain stable are those backed by tangible assets, like gold. There is speculation that BRICS countries might introduce a gold-backed currency, which could attract significant market interest if implemented. David argues that while gold-backed currencies can work, the issue lies in human dishonesty, not the gold itself. In a gold standard system, the main problem arises when more receipts currency are printed than the gold held in reserve, leading to dishonesty and theft of purchasing power. A historical example is when the UK and France demanded gold from the US in 1971, suspecting the US was issuing more dollars than it had gold to back them, which led to Nixon closing the gold window. Even in a modern blockchain environment, human errors and dishonesty can still occur. The only true guarantee, according to the speaker, is a gold and silver coin standard. For more videos like this, subscribe and turn on notifications. Thank you, and enjoy the video.
One is that there's an adage in the financial markets, especially on the tack I've taken it, looking at monetary history: all inflations end in deflation. That's one. The other one is there's never been a time where you've had a true debt liquidating or a true deflation in a fiat system. If you have a gold standard like we had in the 30s, you can get a debt liquidating depression where currency actually became more and more valuable, but it was backed by gold. Not for the populace, it was confiscated and repriced, but for the international gold standard, it was repriced, and it actually helped. So prices actually came down during the 30s, but again, we were on a international gold standard. So, but when you're on a pure fiat regime, every time 100% it's gone into a hyperinflationary depression. Remember, I used the word depression. So you get a currency and you get the same thing almost as you get in a debt liquidating depression or a deflationary depression: high unemployment, high uncertainty, huge jobless rate with a depressed feeling among the populace that things are bad and they're not going to get any better. Much more barter, lower living standards. What used to be taken for granted as almost a staple becomes scarcer. And that then the only difference is in the one, hyperinflation, the currency fails, and a debt liquidating depression or deflation, the currency stays sound. And so the only currencies that stay sound are the ones that were backed by something, and this one isn't. Now the BRICS may be able to mitigate some of this with their own, plethora of countries that have joined using their own currencies. And, there's talk of what they're going to do in this next meeting, where maybe they're going to back their currency 40% with gold. That's out on the web right now. Whether it's true or not, I don't know. I don't know if they know. The possibility, if there was a gold-backed currency, that, of course, the market would probably flood to it at some point in time. You can have a currency or a piece of paper that's, backed by gold, but a gold coin standard where you just, really trading in coins only, is 100%. So no, the idea has usually been around 40. And then, of course, the problem with the gold standard isn't gold. I mean, gold's an inert element on the periodic chart that history says people vote as being the most superior money. That's what it is. The problem with the gold standard is the human element. If you're supposed to have so much gold in your vault, and then you print receipts against it that are greater than the amount of gold in the vault, now you're being dishonest. And that's what's always happened. That's the problem with the gold standard, is how do you mitigate that you really do have that 40%. And now it's 30%. And that's what happened in 71. Basically, the UK and France came to the US and said, we think you're lying. We think you're cheating. We think you're stealing purchasing power. You say we could convert dollars for gold at $35 an ounce. Here's the dollars. Give me the gold. And as the draining of the gold supply started to happen, and potentially draining the whole thing, of course, that never did happen, but Nixon temporarily closed the gold window. A blockchain environment where it's, sacrosanct and it's there and all that, even that still has a human element involved. I think it'd be probably superior to what's done now, or done in the past, I should say, but it's not really guaranteed. I mean, the only real guarantee is, a gold and silver coin stand.
David Morgan suggests that while central banks have started increasing their gold purchases, the broader public hasn't fully joined in yet. According to the World Gold Council, central bank gold buying is at a 50-year high, though some dispute the exact numbers. As economic conditions worsen in the next few years, the trend of central banks accumulating gold is expected to accelerate. For instance, China officially reports holding about 2,200 tons of gold through its central bank. But the true figure, including private holdings within China, might be closer to 30,000 tons, showing a much larger hidden reserve. Silver is currently a better investment than gold, with the gold-to-silver ratio at 78-1, meaning it takes 78 ounces of silver to buy 1 ounce of gold. Silver is seen as undervalued and more accessible, especially in times of economic distress or barter situations where it can be used as money. Investing in silver, particularly at or below its production cost, is considered a solid long-term investment strategy. The speaker compares buying silver to entering the silver mining business. By purchasing and holding the metal, investors can profit as prices rise in response to scarcity. David Morgan believes the economy has yet to hit bottom, which will likely occur in the next 2 to 4 years, marked by a major change in the currency system. This bottoming out will bring lower living standards, fewer goods and services, and a realignment of values, similar to the 1930s depression. Once the economy hits bottom and a new foundation is established, the speaker expects a swift recovery. Let's dive into the interview.
I don't think the run to gold has started outside of the central banks. It's starting to go into the public somewhat, but the real run to gold hasn't really started the central banks. So I sort of contradicted myself. They're just starting to buy more than they have over the last 50 years, according to the World Gold Council. There's others that say that's a misnomer. It really wasn't that much. Regardless, the move into gold is accelerating, but it's just starting to accelerate. As things get worse over the next 2, 3, 4 years, you're going to see the banks go more and more and more into gold. But if you look at the People's Bank of China, I mean, they have 2.2 thousand tons of gold, 2,200 tons. But really, if you look at the aggregate of China, it's probably 30,000 tons. Because when the U.S. asks how much gold do you have, they ask the People's Bank of China what they hold. They give them the number, 2,200. But they don't say, well, how much gold is internal to the Chinese population? It's probably 15 times that. Silver is far superior to gold at this point in time. I mean, the gold-silver ratio is at 78-1. It takes 78 silver ounces to make an ounce of gold or buy an ounce of gold. And the amount of silver that's an investment form is about equal to the amount of gold, probably a little bit less. You can use silver, as money right now. So I think it's very undervalued, even if compared to gold. And it's affordable. It's affordable for almost anyone. So on a legacy investment going out 10 years or more, I think you could hardly miss with silver, buying it basically at the cost of production. If you can buy any commodity at the cost of production, or particularly under the cost of production, and have some patience, you're going to make out. I mean, you can't buy, name a commodity, oil, lumber, cotton, cocoa, sugar. If you're buying at what the production cost is or less, all you have to do is be able to store it, keep it in good shape, and then wait, and the price will go higher. And that's basically the price of silver really is pretty close to production costs. And so you could go into the silver mining business just by buying silver and putting it in a safe, and then wait for the inevitable for the price to reflect the scarcity of the commodity. I think we have to hit bottom first, and we haven't hit bottom. And what does bottom look like? I don't know. I'll outline my thoughts on it. I think bottom is, a change in the currency. I think the dollar will be taken down to some level, a new system, and it depends what the new system looks like. If we have a new system where, it's more equitable and it's not inflationary, and what that looks like, it will be very hard. It will be a lower living standard for almost everybody. There'll be less goods available. There'll be less services available. People will be realigned on a more of a spiritual basis, meaning won't take things for granted like they used to. So it'll be similar to the 1930s depression as far as the psychology. And hopefully we have a high enough moral standard that we had in the 30s that we'll have in the 2020s going forward, that we won't have a lot of violence or social unrest, although I expect we will have that. So once we get through that, and we have a foundation to build on, I think we can build back fairly quickly.
The importance of holding tangible assets like gold and silver as a hedge against economic instability and potential currency system changes. As we navigate these uncertain times, investing in these metals could provide a safeguard and a pathway to financial resilience. What are the potential challenges and risks associated with a gold-backed currency, and how might these affect its implementation by countries like those in the BRICS alliance? Share your thoughts on David's insights in the comments below. Don't forget to like this video, subscribe to the channel, and turn on post notifications for more content like this. See you next time.